Mr. Shahid Balwa from the company is joining us on the show. Hi, Mr. Balwa. Good to be speaking with you. The latest for the company being that demerger that you've announced of the hotel business. Talk to me about the rationale of that, and more importantly, what's the listing timeline that we should work with?
So, as you know, Valor is a real estate company which focuses on land, banking, etc. Uh, we also have a unit within this within the company which is the hospitality unit. Obviously, there is a lot of opportunity for hospitality to grow, and the hospitality business we believe that it needs to be independently managed, to have an independent capital base, and something that will delisting will obviously help it in terms of focus, and also in terms of raising capital in the future for the company, as as we intend to grow that business into a large hospitality entity. We currently have two operating hotels, which is the Hilton at Mumbai and the Grand Hyatt at Goa. Another two operating hotels will get added to this portfolio sometime next year, which is the St. Regis at Delhi and the Marriott Marquis Delhi, along with a convention center and a office block, which is essentially the largest hospitality project in the country ever built, and it is both in terms of size and capex. And then we have three new hotels that are planned in Mumbai, which is a 1,000-bedroom hotel at the airport,
Okay.
a 1,300-room hotel in BKC, and a 800-room hotel at Worli. So all these hotels are large capex projects, will require focused approach. Will need a specialized team to look after that, and that is essentially the rationale of the demerger. The demerger also will unlock value for the existing shareholders.
Right.
And that is essentially what we intend to do going forward.
Sure,
In terms of timeline.
Yes, Mr. Balwa, that's my next question on the timelines, and also what will be the split of the debt between the two companies?
So, in terms of timeline, we are hoping that we will be able to do it within this financial year. All the approvals from the board have been received. We don't need shareholders' approval in this case because there is a one-to-one. Essentially, for every 10 shares that you own in Valor, you will get 1 share of Advent, which is the demerged entity. And insofar as the debt is concerned, only the debt which is being carried by the existing hotels will go with the new demerged entity. That will also essentially make Valor debt-free, and the operating assets along with the debt that they carry will go into the demerged entity. We have currently about 600 crores of debt, give or take, on the existing projects, existing operating hotels. And we will have, once the Delhi project is operational, we will have about 1,000 crores adding up to that. So it will be 1,600 crores of debt that will go to the demerged entity, and the real estate entity will be left with no debt.
That's interesting. That's a very interesting carve out, because debt also, comes to hotels business, and the realty becomes debt free. I want to talk about how the independent books of the hospitality business look like right now. What is the debt now with this which is carried away? What is the kind of capital which is there? And sure, you have some operating assets and some prospects asset. You also bought out a hotel. How will you fund that, and what is that capital requirement versus current capital look like?
So whatever capital is required for the existing two operating hotels is already provided for by the company. So no new capital is required insofar as the existing operating hotels are concerned. The Hilton Mumbai is a debt-free hotel, so there is no debt on that hotel. The Grand Hyatt Goa, which is housed in a subsidiary, Goan Hotels, has a debt of about 560 crores. So between the two operating hotels, which have an EBITDA of close to 150 crores, the total debt is about 560 crores. The Delhi project is a 4,000 crore project, in which the debt is about 2,000 crores. If the financial closure of the project is already done, the hotel is already under construction. We, as 50% equity shareholders in that company, have contributed about 700 crores of equity so far. Prestige has obviously contributed equal amount, and we will be contributing another 300 crores, and Prestige will be contributing another 300 crores. So that's as far as the Delhi hotel is concerned. The two projects, the project in Mumbai at the airport, which is housed in a land that we already own, which is debt free, that will go into the demerged entity. We will raise debt for that project of about 2,000 crores, and we will have to also contribute about 700 crores of equity in that project, considering 600 crores of land value. So that will be the Sahar project. The BKC project is interesting because we are tying up with we are in the final process, final stages of actually announcing that with a very large real estate company. So as part of that understanding, the hotel structure with the underlying land will be constructed by the developer and handed over to us without any cost to us. So we only have to do fit out of that hotel, which is going to cost us about 750 crores. That will be funded by debt. And the Worli hotel is also in a similar arrangement. The hotel will be built, the structure will be built and handed over to us, and we will own 50% in that, and we'll have to do the fit out. So not substantial equity going into the BKC and the Worli project, but some equity will go into the Sahar project and the Delhi project. So overall, we look at about 2,000 crores of equity and 4,000 crores of capex into the demerged entity.
Before we let you go, Shahid, just a quick word. I understand all of this, but for a shareholder and a viewer point of view, how much potential EBITDA can the hospitality arm generate with these arrangements over the next 3 to 4 year period? Because I'm assuming the current assets, contributing assets, may be just 2, but the pipeline from here on could be interesting. So if we take a 3 to 5 year picture.
So if we look at, and I will just refer to my notes, but on a broad scale, by 2029 is when we think all the hotels that we have planned will be operational. But we are looking at almost close to almost 1,000 crores of EBITDA coming from Valor, from Advent as a standalone entity.
So 1,000 crore EBITDA by 2029, that's when all those assets will be operational. Thanks, Mr. Balwa, for making time and speaking with us. So clearly,
if you like this video, then like, share and subscribe to ET Now.